When I first started investing, one of the most confusing things was understanding the difference between index funds and ETFs. Everyone kept saying they were both great for beginners, but no one really explained how they were different, or which one was better for someone just starting out. So in this video, let's clear that up. If you're new to investing and trying to decide between index funds and ETFs, this is for you. At a glance, both index funds and ETFs are similar. They're baskets of stocks, not just one company. So instead of putting all your money into a single stock like Apple or Amazon, you're spreading your money across many companies at once. This reduces your risk and makes it easier to grow your wealth slowly and steadily. But while they sound alike, there are a few key differences that matter, especially for beginners. First, let's talk about how they're bought and sold. ETFs, or exchange-traded funds, are bought and sold like regular stocks. That means you can trade them at any time during the trading day, and the price will fluctuate throughout the day. Index funds, on the other hand, only trade once per day, after the market closes at a fixed price. For most beginners, this difference might not seem like a big deal. But if you're someone who likes flexibility or plans to make frequent trades, ETFs might feel more familiar. Then there's the question of cost. Both ETFs and index funds tend to have low fees, and that's one of the biggest reasons they're recommended to beginners. But in many cases, ETFs have slightly lower expense ratios than index funds. And depending on the broker you use, ETFs might also be commission-free to trade. That said, some index funds, like those offered by Vanguard or Fidelity, have extremely low fees as well. If you're investing regularly through a retirement account or automatic contributions, index funds might be the simpler choice. Another thing to consider is the minimum investment. Many index funds have a minimum starting amount, sometimes $500, $1,000 or more. ETFs usually don't. You can buy just one share of an ETF or even a fractional share depending on your platform. That makes ETFs a bit more beginner-friendly if you're starting with a small amount of money. Now let's talk taxes, especially if you're investing in a regular brokerage account. ETFs are often more tax-efficient because of how they're structured. Without getting too technical, ETFs usually create fewer taxable events when the fund manager buys or sells assets inside the fund. That could mean lower capital gains taxes for you. But if you're investing through a retirement account like a Roth IRA or TFSA, the tax efficiency doesn't matter much, because you're not paying taxes on gains anyway. So which one is better? The truth is, both are great options for beginners. If you want to invest automatically every month and don't care about intraday trading, index funds might be a better fit. If you want more flexibility, lower minimums, or the ability to trade during the day, ETFs could be your go-to. The most important thing is that you're investing in something low-cost, diversified, and consistent. That's the foundation of smart investing, whether it's an index fund or an ETF. At the end of the day, don't let this choice stop you from getting started. The biggest mistake is not investing at all. If you found this helpful, give the video a like and subscribe to the Cash Blueprint for simple investing videos every week. Thanks for watching, and remember, it's not about timing the market. It's about time in the market.